For this video, we'll be talking about the very near term for US market. Here are some of the topics that we'll be covering today. So let's talk about the upcoming stimulus bill. 70% of the US GDP is from services, and that's kind of why US is taking such a big hit because people are not going out and spending. But spending doesn't actually stimulate long-term economy growth. It just and especially if you're going into debt for spending, that means you're just taking spending that was no otherwise available in the future and you pulling it to the present. Now, the money going to citizens are mainly put into consumption. Obviously, you have some people who have extras and they're putting it into Robinhood trading accounts, buying fractional shares. Money going to companies are just keeping them afloat. There's no increase in production, but rather most companies are being shut down, and the funds that they're receiving are just mainly to be used for repayment of debt. So they're very highly leveraged. The market has been now trading below 1% up and down, lately anticipating another stimulus bill. In my opinion, they're factoring a pretty significant bill. So meaning unless Congress surpasses the expectations, there is no upward momentum here. And there's no one denying another stimulus bill for deficit or national debt reasons from the both Democrat and Republican side. The reason they're only debating is just they want their own take in it. And this means there's no one stopping more of money printing because any additional national debt right now, about 60 cents. So every dollar that US Congress spends additionally, 60 cents is coming from Federal Reserve. And Federal Reserve as a central bank doesn't generate anything. All it does is just adds numbers in the computer. And by definition, that is increasing the money supply, and therefore it is inflation. The only thing is just the time lag, because what happens is, the central bank adds the number value, it goes to the person doesn't, average Joe maybe doesn't go out to spend it right away, but when he does, buying up some goods that someone else could have bought, what will happen is there's more money chasing decreasing amount of goods, so that by definition bids up product prices, and that's what we will be seeing very soon. So Nasdaq rally recently has actually slowed down in comparison to the S&P 500. And the FANGs are actually seeing their beta, which is their correlation between their performance comparing to the index, actually seeing it approaching 1. This means that they're no longer outperforming the index, meaning they're not leading the index higher anymore. And they are the ones that are heavily weighted on the Nasdaq. So the FANGs, wasn't sure anyone who don't know, it's Facebook, Amazon, Apple, Netflix, and Google. And funny enough, I think I saw or overheard some news analyst was saying that the FANG stock market cap actually just exceeded Japan's GDP. So could you imagine like 5 companies being worth more than Japan, a country that is the 3rd most in terms of GDP. So for unemployment data, we're actually seeing from today initial claims. We're seeing the first spike up in terms of initial claims figure, but even though these data are very volatile, but this is quite interesting for seeing another spike up from March. So we might be seeing more business closure. That's kind of where we're going with, and the most dangerous part of the initial claims data is as more and more people are unemployed and they stay unemployed, they're moving from temporary to permanent, and that has implications where it's a lot harder to get back from unemployment once you have been unemployed for an extended period of time. And that's something that they're trying to avoid. But this has implications. So now let's take a look at the US dollar index. Now, from year to date when it started, the year it was at 96.5, so it's only down like 1.6%. But if you actually take a look at the March high after the market kind of took the initial dive in March, it's actually down 7.7% from the March high of 102.82. And this is really scary in the sense that from March to now, like what, 4 months, if you just stayed in US dollar cash, regardless of like nothing happened, you just held it, your value on the dollar have lost 7.7%. So when you actually take a look at the stock market as a foreign investor, whatever gain you have made, you have to discount it by the drop in the dollar. And so as the US dollar continues to fall, this really reduces the incentive of foreign investors. So let's take a look at insiders dumping. So from this chart that was from Washington and Bloomberg, it shows that from historic insider buy and sell ratio versus to the S&P 500 index, as you can see at various points, once they sell, they don't really come back until either I guess they could be the one that's creating the bottom, or they're the one that's just buying in from the bottom. But a key takeaway is that they don't come back until it's done completely. So they're not buying at like 200-300 point drop, or like they're not coming back until the very bottom. So everyone that has participated in this rally has been mainly the retail investor, obviously the traders. The traders just trade on volume and volatility, but it's the retail investors, most of them on Robinhood, buying fractional shares. And this means when this market starts to fall, there's no one catching it. So it's going to go down a lot. So COVID cases just surpassed 4 million a few days ago. That increases the pressure for states to return to closure, and that means there will be more business closure, and that will mean less employment and people less spending, and as a servicing economy of 70%, that means a lot of continued negative impact. Hopefully they'll come up with vaccines fairly quickly here. So like I just mentioned, for as cases continue to rise, citizens are not able to spend as much, they're going out less, businesses aren't getting the same level of revenue as they normally do, and they're not going to the pre-pandemic levels, so company earnings are continuing to suffer, obviously ignoring the COVID trades, the stay-at-home trades, and that's continue to push valuation to decouple from reality, where the normal earnings for like most companies are still decreasing, yet the index is being pushed not to prior pandemic levels, but surpassing it, where the Nasdaq is making new highs, and that means valuation is really the question here. So some key takeaway: COVID-19 cases continue to rise. This puts more pressure for business closure, and therefore more unemployment. And eventually what will happen for these businesses is they can't stay afloat and they will just have to file for bankruptcy. And these temporary unemployment will become permanent, where the jobs that they thought they were able to return to are no longer there. Unemployment data follows the increase in COVID cases, which I just explained. Earnings is definitely under pressure, and the high net worth are not returning. They're holding cash or I guess short-term investments and other places, but they're not returning to this market anytime soon. And finally, if valuations will have to come down, and it's not a matter of if, but when, and when it does, when the bottom drops off, there's no one's catching this, and it's going to fall very soon. That's what in my opinion, I'm expecting a fall quite soon. We might see the test of March lows, but we definitely won't be going down to 2008 levels just because the amount of Fed stimulus that has come in. And the only reason why the Fed stimulus wouldn't be enough to save this is because the amount that actually gets to retail investors, they're going to be the ones that's suffering the losses, so they might be very discouraged to come back in with any additional funds. Also, I'm expecting inflation to go up, and that's why they won't have the extra funds to put into the market anyways. And money that are going to businesses are just keeping them afloat. Any funds that banks are getting, they're not taking the risk and loaning them out at these rates, because what happens is, yes, if they keep it, they can buy securities with it, or mostly they're going to buy treasuries generating like lower yields, maybe like 1 or 2%, but obviously net of inflation you're still losing a little bit. But if they are to lend it out to businesses or individuals, if the people they lend to loses the ability to repay that loan, maybe they recover like what, 30-40%. That's still a much more significant loss as if they were just taking hit from inflation. And so that's why the banks are now reluctant to lend out money, and that's why you see, even though rates have gone down, their premiums have actually gone up.